Good morning, everybody. I'm going to take a few minutes here and talk to everybody about my experiences of being a public company. And I'm going to do this from the perspective of a dealer. You know, like many of you in the room, I started with a one-store dealership in the middle 70s. Grew it to, a 6-store location in 2000 the time frame. Really started thinking about, what's your exit strategy, what's your succession, how can you take the company to the next level, and really chose the route to start down that road to, with the possibility of becoming a public company. So if you take a look here, here's some public companies that are out there: H&E, Rocky Mountain Equipment, Toromont Service, Rush Enterprises, who's actually a truck dealership group, and Finning. So there are some public companies in the equipment business out there in the public markets. So why go public, or why be a public company? And the first thing that comes to mind is capital. In our industry, from a legacy of manufacturing floor planning, I remember when I first got in business, we had 2 years interest-free floor plan on equipment. But because of that, I think this industry as a whole is an undercapitalized industry. Now you compound on that, when I first got in business, tractors are $20,000 and $30,000, combines $50,000. Now we're looking at taking in trades that are $300,000 and $400,000 trades. So the price of equipment's really grown. In addition to that, the sophistication of the business, the tools and equipment we need, the 3-axle trucks, the 3-axle trailers, then to throw in on top of that some $4 and $5 million buildings. In my case, when I had business, my manufacturer had the first security lien on everything that I had in the business. So anytime I needed capital, I had to go to a bank and talk about, lending me money and taking a second position behind the manufacturers. This has all been accentuated then by the economic downturn we had in 2008 and 2009. So in a whole, this capital need was really one of the big drivers of taking the business public. You look at this thing of permanent capital. What's this permanent capital out there? And I know every year I did a bank renewal. I had to go back into the bank. You have the rules of the bank examiners, and every year you didn't really know kind of what footing you're on. I know back in the 80s, all the major banks, they pulled out of the ag markets. I mean, there was, farmers couldn't get credit, dealerships couldn't get credit. Then you take that one step further and you think about, okay, you've got an exodus of a dealer principal, or death of a dealer principal. Then all of a sudden you've got a fairly undercapitalized distribution channel, and now you've got that exodus of capital out going to heirs, estate taxes, and all those type of things. So the idea of growing your business and investing in it and getting larger and increasing your product support and all that with after-tax dollars becomes very difficult. So this idea of permanent capital in your business. So some recommendations if you're thinking about going public, what are some things to think about? The first thing is, do you have scale? It takes a certain amount of size in order to even think about doing this. Do you have a long runway for growth? And here we're going to start thinking about here of both organic growth and new store acquisitions. Do you have a 3 to 5 year history of both earnings and revenue growth? If you're going to go public, the fund managers out there, the manufacturers doing business, everybody look at it. Do you have the track record that you can really do a good job of taking your company to the next level? Do you have a sustainable and scalable organization model? These are all things you need to be thinking about if you're going to go public, and what the public markets are going to be looking for. So some recommendations, first of all, is to beef up the accounting departments. Positions like CFOs, controllers. Do you have an audit function in your business? What are you doing for external, internal reporting? You're going to need to do a 3 to 5 year business plan out there. You're going to have to really take a look at that. And once you do these projections and you put this business plan out there, do you have a viable public company? Is your business going to have that growth? Is it going to have the organic growth, the acquisition growth? Is it going to have the balance sheet metrics? Are you going to have that return on the investment that the manufacturers are going to like to see? So what to expect as a public company. So first of all, this financial performance is critical, and there's a thing called guidance out there. So when you're a public company, you go every quarter or every year, you go out to the public markets and you give them guidance. So you're really going to forecast what are you going to do out there. So with this guidance is you're gonna say what your earnings per share are going to be, what your revenue is going to be, what your inventory levels are going to be, and really you need to execute on those expectations. And the public companies, you're really benchmarked on your peer group out there. So it's important that you hit those numbers. If you don't hit their numbers, it really affects your stock price. You've got these what to expect as a public company. You're talking about this SEC and SOX requirements, well-documented business practices. And back with the Sarbanes-Oxley Act, because of Enron and the things that happened with that, there was some major problems out there, and if people invest in companies, they want to make sure that you've got the assurances that your company's going right. So they put these SOX practices into place, and with those, I mean, a lot of this is good business things, but it takes the people and the staff in order to get those type of things done. There's mandatory compliances about that. There's a certain amount of seriousness about that. Another thing to do as a public company, you're going to have to go spend time with your investors out there. There's investor conferences. You probably have to plan on doing this for about 6 times a year, is go out and visit with these investors. Earnings releases, continual phone calls from these fund managers, meetings with institutional investors out there. And these fund managers, they really model their business. In fact, they probably know more about your business than you do. They do some really sophisticated models on what to do. So I just have to go back here a little bit. So when we talk about some things, I'm going to talk about here a little bit about this business value. And you talk about it's one reason to go public is because it does bring your highest value into the business. If you look at Walmart, for example, people invested 100 shares in the Walmart stock when they went public. Today is worth $10 million. So it brings you the highest value for your business, and it's going to be based on this earnings multiple. So what the stock market does right now, if you've got growth and if you can hit your expectation numbers, they're going to give you a multiple in your stock, which you really don't see in other ways of. So really at times it can bring the highest value for your money. And one thing I was told that made a lot of sense, don't be so concerned about, what percent of the company you own, but be concerned about what your percent's worth. So as you're starting to think about some of these things. Recommendations, we're talking about putting together an independent board of directors. You want to put in a good board, and there's people out there, now they don't necessarily have to be from this industry, but they should be from businesses that had experience in going public, people that went to the debt markets, people that did these type of things. You want those people on your board of directors, and I know we did that, and we put our board together that had these type of people in it, and they really help you, and they help you get to where you want to get to with that. I'm going to say with what I know again, would I do this again? So one thing that's been a real positive is the senior talent you can bring into your business, and this ties a little bit to their scale. But I know as I was running my store, I was wearing a lot of hats. I was a dealer principal, I was a sales manager, I was the HR guy, the IT guy, I did the casualty insurance, I did the manufacturers relationships, I was the one that did the business with the bankers. That's important. All of a sudden now you go to a public company, you can put this next senior team in here, which is really important. You can get experts that can take care of all these functions. I think what it does is it brings your company to a higher standard. You can get people up here that all of a sudden really professional people, and it really brings your business up to that next level. Not only what you can do with your people, but also what you can offer to your customers. Access to capital. What we did is we did our IPO in 2007, but then we did a follow-on offering in 2008, another one a year and a half ago. And every time you do this, you bring not only capital into your business, but you also bring in personal liquidity for myself. Another thing to do when you talk about liquidity and capital is on that. it gives you a chance to access the debt markets. You know, we've accessed the equity markets with the follow-on offerings, but the debt market is a whole nother group of people from the public arena. So you can actually go out, and this last year we actually went out and did a large debt deal, which being a public company actually gives you access to that. The business value for myself personally and for our business, you know, this has created a lot of wealth that wouldn't have been there without doing a public company. As far as from a succession plan, you know, all of a sudden now you've got all the business metrics. Now they're out of your business now all of a sudden. So really from a succession standpoint, it's talking about developing people. You know, so once you have the ownership issues, a lot of people say, I want to get out of the business. You talk about these ownership issues, but now those are out of the business, so really you need to be talking about, you know, the people side of the business. So from that standpoint, it's pretty good. So it's giving me succession flexibility, liquidity, increased value in the business. So like I said, overall it's a real positive, you know. Are there some challenges out there? Definitely. You're spending money on accounting, you're spending money on compliance, you need to work with the fund managers, you need to do certain things in your business which are good, and also doing it, but in the long run, I think going public's been good for Titan Machining, it's been good for David Meyer, and I think it's really been good for our employees. So with that, we'll be around here to answer some more questions, and thanks for your time, and looking forward to spending the rest of the day with everybody.